Hello, Matthew Copley here with Copley Financial Group. Today we're going to do a market update, give you an idea of what we're looking at in the markets, and honestly not a whole lot has changed. We are seeing kind of the same type of market where you have the earnings on companies doing very well. You're seeing a lot of the leading economic indicators showing a recession. In fact, I mentioned in a previous video that June of 2024 is kind of the recession date based on projections and historical time frames. Well, at the end of the day, looking at leading economic indicators and the negative leading economic indicators, we should be in a recession right now. And so my guess is we'll probably enter some type of recession between now and June of 2024. So we are prepared for it. And I don't think, everyone thinks that a recession is going to come and the stock market's going to crash, the housing market's going to crash. Well, at the end of the day, the valuations have to be out of sight. You have to have a bubble in order to have a crash. And when we look at current valuations in the market, they're not too bad. Companies are making money. There's profits out there. The recent quarterly reports from most of the companies reporting came in better than expected. So the earnings are there, and ultimately the stock market is worth what the companies are making in profits. Now, of course, if we do go through a much worse recession than is anticipated, then possibly things can change and get worse. At the end of the day, you just want to take advantage of all of the opportunities that are out there right now. One of the things I always remember is back in 2007, I was really concerned about the stock market and the housing market. And I was so concerned that I was telling everyone to sell their own house. I sold my own house and I rented intentionally before I bought back in after the crash. And back then there was a bubble. You could see it coming. And it's funny, there's a great story I have. There was a company that I did a lot of business with back in 2006 and 2007 that had guaranteed interest rates. In fact, we could get over 6% guaranteed interest rate. And so I was moving a lot of our clients out of the stock market and into these guaranteed interest rates. And it was a great product, great thing at the time. I thought there was going to be a big crash. Well, this time around we have high rates again, and so we can get guaranteed interest rates. And I love these products, and it's something we should definitely take advantage of. But I'm not doing it because I think there's going to be this major crash like 2008. Just so you know what the rates are out there, we can do a 3-year at 5.25%. A 5-year at 5.22%, a 7-year at 6.10%, and a 10-year at 6% even. Now, some people might say, well, Matt, why would I put it in for different terms? Well, there are some caveats within these different insurance contracts. These are obviously the MYGAs that we've talked about before, the multi-year guarantee annuities, which are basically CDs with an insurance company. The 3-year, the 7-year, and the 10-year are interest. You can take interest withdrawals. So the interest is penalty free. You can take the interest anytime, which is fine. But the 5-year is interesting. I actually kind of like that one a lot. It's a 5.22% interest rate, and that one has a 10% penalty free withdrawal available. And so if you were to say put in $100,000 into that, you're getting your 5.22% guaranteed, and what you see is what you get. That's it. You get 5.22 fully insured. You can actually have access to $10,000 a year of that $100,000 every single year during the 5 years. So if you were to put in $100,000, you get access to $10,000 each year. You got $50,000 of your 100, half of your money available during the term. And then of course you get everything at the end of the 5 years. And it's a pretty good deal taking advantage of these high rates. It's kind of like when interest rates really drop really low, you want to take advantage of that by refinancing the mortgage on your house and taking advantage of the low interest rates. Well, now that interest rates are higher, you want to take advantage of the high interest rates. And so that's something we want to definitely take a look at. So those are obviously products we like. I love the Buffered Index. The Buffered Index is a great product. It's performed better than anything else for us. That's the one that goes up with the stock market up to a cap, has a great insurance reimbursement, and if the stock market drops down to the buffer level, you actually get the inverse return, so you can actually make money when the stock market goes down. The current one we have is a great one. It's a 2-year stock market. It has a 27.57% cap, And so that's over 2 years. It has a 20% inverse return. So if the market's down 10 or 15, you actually can make the opposite return on that. And then of course it has a 20% insurance policy buffer. So that's a great product. So having money there, having money in the insured accounts with the guaranteed interest is smart. And then of course right now the valuations in the stock market are bad. We have great quality dividend stocks, valued companies that are trading at very, very good PE ratios. And when you look at some of these ratios as far as earnings, what we're typically looking for is historically the stock market trades at about 18 times price to earnings ratio. Well, if you remove some of these companies that are really expensive, that are in the S&P 500, the Amazons, the Facebooks, those kind of companies, the Teslas, you remove those and just invest in the higher quality value companies, current PE ratios are below 15. So it's actually cheap. The stock market's in a pretty good spot. Now, obviously that's based on current earnings, which are coming in pretty good. We're watching that. Obviously, if unemployment spikes up and there's a problem, then we want to maybe change what our thoughts are on this. And there are some problems around the world. Obviously, we all know what's going on in the Middle East. We all know what's going on in Ukraine. One area you might not be aware of is there's some serious problems in China, especially their banking sector, which could spread and create problems around the world. So we're watching that closely. At the end of the day, taking advantage of the high quality value stocks, taking advantage of the buffered index, the guaranteed rates makes a lot of sense. Now, of course, the one thing that I want to make sure everyone is on top of is any of the tax reduction strategies. We do have a lot of stuff available. We've reached out to just about everyone that could to take advantage of this. And if you'd like to reach out to us, we're happy to chat with you just to make sure. But there are a lot of options now to take advantage of Roth conversions, potentially with a valuation discount. We have various charitable land donations and things that are available to cut taxes. So now is a good time with the end of the year coming. We only have a week or two left to potentially do some of this stuff as far as tax reduction. So definitely reach out to us if there is anything in that area that you want to take a look at as far as tax reduction. Happy to help. So that's all I have for you today as far as a market update. Hopefully we'll have a more exciting market update next time. But for now, just so you know what's going on, thank you all for watching. I hope to see you in our Mission Valley office very soon.